Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 2nd, 2022. The S&P 500 currently sitting at 39.37. I'm David Zarling. I'm here with Ian Clyde Drexler McMillan. S&P.
Clyde the Glide.
Clyde the Glide. He was a dude. You get to visit his homeland. Well, I don't know if it's his homeland, but he played a lot of years there. S&P about minus 3% at this point in the day on the week.
Oof.
Not necessarily surprised by that, right?
No.
We talked about a falling 200-day moving average, price below that. We talked about 4180. How many ever times on here? We're below that. Where to from here, though?
Yeah. So markets have obviously coming off that, nice rally June and July. And there were a lot of good things that came out of that, like the breadth thrusts. I don't think anyone's going to argue that the breadth thrusts were pretty solid.
Talk to me.
Just the amount, like stocks that were moving higher, stocks making new, 30, 40-day highs, stocks above their moving, certain moving averages, lots of data out there being thrown around. Now, 52-week highs, not so much. But it was a strong, the bounce we had was, what you would expect to see off of maybe a significant bottom, but that has rolled over since. We've given up. Gosh, Dave, we were talking right before we got on here. We're back to this original kind of base breakout from July 19th.
Yeah, pretty important around 39.05.
Yeah.
There's some structure there. That's the closing low from May was, 3,900. And so that 3,900 seems to be the next important level. But to your point, when you talk about breadth thrust, you're just talking about participation for those who might not be familiar with.
Yeah.
For example, July 19th would be a good example. That was a 92% up day, meaning 92% of things in the New York composite we're moving to the upside. That's a large breadth
we had
thrust.
A bunch of
and I actually didn't do that
80% days throughout June and
a bunch of 80% days. But what's interesting is you said July 19th just a moment ago about that breakout, right? The breakout of that base in July 19th, and that was the date we got that 92% up day. Which is my first time noticing that. And, we've had other days, like you said, back in June, we had some 80% up days. August 10th, we had a 91% up day. But, it's interesting to note, for example, almost a 93% down day, August 26th.
Yes. So, and that was the third time this year that we had an 80% up day followed by a 90% down day.
Oh, really?
Happened once in 0 times in 2021, and I think once in 2020. I didn't go back before that.
Okay.
But
let me guess, there's one.
4 times over the last 3 years, and 3 of those 4 times have happened in the last 3 months.
So it's like a sloshing of participation, meaning like if you think of like a bowl of water and you just kind of start shaking it around, the water moves to one side and then it moves to the other. That kind of sounds like what you're describing there. Is you get these, if we've got a breadth thrust to the upside on July 19th, we have a downside thrust of participation on August 26th of this month or of the prior month, which not coincidentally took price back below that 4180 level. And so here we are back below prior lows, back below the high from late May, early June. We've got falling 200-day moving averages. The thesis of a bear market continues.
Yeah, unfortunately, the bear markets don't go straight down like bull markets tend to go straight up.
Yeah,
As much as
a slowly grinding lower.
If bear markets just do what we know they're going to do.
Yeah,
they wear you out.
They do. Well, and that's I think that's something we can discuss a little bit later. But just there seems to be a lot of sentiment interpretation going on, and that's fine for most market environments. But I will say sometimes sentiment just gets floored. Like the market starts going down and everybody's bears, but that just keeps happening. But as far as when we look at the market overall, if we slice it up like a loaf of bread and we've got these different sectors, with tech being the largest slice in the loaf, what are we seeing from a sector basis out of this market?
Well, 1 point for the bears would be utilities.
Okay.
Breaking down on an absolute basis.
So
failed breakout on an absolute basis. New highs on a relative basis.
Ooh, bad combo, right?
Bad combo from our perspective.
Yeah, let's walk through that because, for us talking shop internally, what you just said makes a ton of sense to me. That you have utilities made a brand new all-time high, failed, so a false breakout, but on a relative basis, it's doing well. Why is that bad?
Well, you don't want to see utilities outperform. Like if, participants are going to be serious about buying stocks in a risk-on environment, you typically would not see utilities outperform.
Right. There are periods of time it does. Obviously, if we're talking about, months to weeks, periods of time. And I do believe there was a point in time, but this would have been back in the value trade of 04 to 08.
Well. And maybe we're going back into that, maybe we're going back to that environment. No,
right.
No one knows right now. But big thing there is failed breakout. I mean, really, let's talk about tech.
Yeah. One thing I wanted to get your thoughts on here real quick before we go to tech. So if you pull up a big long-term chart of XLU versus S&P, XLU being the ETF for utilities and S&P, we're all familiar with that. Looks like some type of false breakdown on a massive scale.
Yeah.
And so that goes back to your thesis about, is this a value trade? So stocks go higher, but it's value that outperforms. Or is this a flight to safety? Right? Because that's the other argument, is that utilities are a safety trade.
Yeah. And if you've got to be long, if you're a manager with a mandate, you have to own stuff.
Yeah.
You're going to run to the low beta stuff, even if you think the market's going down.
Right. So sorry about that little interruption there, but
no,
big picture. And so you were pivoting us towards tech.
Tech continues to look, I would say it's going to have most likely another weekly, big red candle. It also got rejected off its 200-day. Apple, still holding up above one. Apple, what do you, that's the one that holds all the answers. And it continues to, it's not horrible. It's not great. We're coming off a pretty decent decline here, 10%, 11%-ish from the highs.
It's worth paying attention to for obvious reasons, because we've harped on it enough that it's one of the last titans. It's massive part of what some would say is the market. We know that the S&P 500 is not the market, right? Because if we just said the S&P 500 was the market, then we would say we've been in a bear market since January. But we know that's not the case, because many stocks have been in a bear market since February 21.
And some stocks haven't been in a bear market at all.
Right. And it's
few energy,
right. But also like Apple, it's worth noting that we have an RSI divergence on a relative basis versus the S&P. And we've kind of got a gap here on a relative basis that started out this Monday, until Apple reclaims that gap. I don't know. This goes back to risk and reward. There's a gap here. You could argue it was filled on August 26th. There's that date again. August 26th may go down as an important mile marker. I know the fundamentalists and those who follow the news too much would talk about our favorite friend, Jerry and Jackson Hole. But for us, we'll just follow price. And that date seems to have some type of significance when we look at price behavior of market participants, even involving something as big as Apple on August 26th. And so tech, if you were to compare utilities versus tech, you talk about relative breakouts. That's also, if you just took the ratio of XLU versus XLK, so taking the ratio of utilities versus technology.
Yeah, good eye.
You're on the verge of a pretty big, this is a multi-year base potential breakout where you're going to own utilities over tech stocks. It's interesting.
That is.
That's not really risk on type behavior.
Not saying that they can't both go up.
Correct.
But yeah, utilities over tech. This is not a new development. It's been going on since late December. And really, we've just been consolidating for a few months.
Yeah. So it's notable. And this goes back to the backdrop of utilities having a false breakout. So we're not sitting here saying that utilities are making new highs and moving higher. They're also moving down. They're just moving down less. And that's a warning.
That's the issue. Exactly.
That's the issue.
Well, anything else? Anything else that from like a sector strength or weakness that has piqued your...
I think financials.
Really?
Yeah, I'm curious about financials.
Like the failed relative breakdown?
Yeah, the failed relative breakdown out of a range that goes back to, well, here's that date again, February 2021.
Mm-hmm.
There's a range, and financials have outperformed here for a few weeks. Nothing dramatic, 4 or 5 weeks, but it's reclaimed a relative ratio low and moves higher. Now, again, this goes back to, we're talking in relative terms, still down on the week on an absolute term, and was rejected if we're using something like XLF at the 35 level. So until XLF is above 35, this, I'm not sitting here recommending people get involved with financials. It's just interesting that it's outperforming the S&P over the last 5 weeks in an environment where people might say that shouldn't happen. Although, yields are up over the past 5 weeks. So
yeah, have we gotten a breakout?
On a weekly basis, if I look at TYX,
okay,
on a weekly basis, if we were to close right here, it's the last time we would have been here since 2018. So it would be a new high,
weekly
higher than
high.
Yeah, but it's.
And hasn't Pratty pointed out some of the lower duration ones having 2 years broken out, 2-year rates?
Okay, let's look at start. We'll go back down TNX is not.
TNX is not.
But to your point, if you're looking at rates, you typically see your lower duration rates move higher, which they did. Yesterday they broke out to new highs. Today, trying to threaten a false breakout.
Yeah,
but they did.
2-year yields. They're above their 2018 highs. Yeah.
And they have a tendency to lead. You tend to see those go first and the other ones follow. We'll see if that's the case. But maybe that's the intermarket analysis of that's why financials are moving a little bit higher, rates are moving a little bit higher, but that doesn't have to be the case. Maybe it's value, right? We just got done talking about utilities.
True.
Financials are value, so maybe it's the value trade. Let's not overthink.
And if we're going to go into this raising right environment, no matter what say stocks do, we go into a raising right environment, and stocks do okay. We're in a broad market uptrend. Yeah, not to get into the macro, but I assume that people are not going to be super excited about buying growth stocks if rates,
Right.
Now could be totally wrong. Maybe rates go higher and the market still decides they love
Cloud computing
cloud
stocks.
computing and these little software names.
Could happen. It's a
Could happen.
It's a non-zero chance, but it's also a small. At this point, that thesis pretty limited, right? Because we're seeing big tech, we're seeing small tech fall off. I mean, I feel like it's been a little while since we talked about semiconductors.
Talk about areas that had another rough week.
Those are areas that we want to see do well. The transportation of data through semiconductors, we want to pay attention to that. And we want to pay attention to the transportation of goods. And so same thing with transportation sector, still not out of the woods yet.
No. Rejected its 200-day, like a lot of things.
And we could get into a technical debate about the 200-day and whether that's resistance or not. All we know is that that's an important line. You're talking about an average. You come back to that average. You typically don't stay around there too long. It's just an average.
Yeah.
It's important. But so what's another, if we were talking about growth versus value, I know we've talked about energy on here. That would be what other people would consider value.
Yeah.
What are we seeing out of energy?
Oh man, they're trying. They're trying to hang in there. I mean, XLE is still above 80 for now. I mean, we're sitting right there. We did make a move. We'll see if this fails. As far as the underlying commodities, crude got rejected. Crude looked like it was going to make another move above that 95 level this week. Rejected also at its 200-day. So,
and I think that's a good exercise that you're going through there, because some of the things we've talked about, technology using XLK, rejected its 200-day, that's falling. Energy, on the flip side, rising 200-day and was supported there. I'll use that term loosely. In July, tested the 200-day, rising 200-day, moved higher. Utilities, same thing, rising 200-day, tested that back in July, moved higher. Now, of course, it's still a little suspect because it had a false breakout. But the point being, when you consider that, there's definitely areas that are in uptrends, and the bigger areas of the market, not as much.
Yeah.
Semiconductors, we talked about them, even financials showing some relative strength, but that's below a falling 200-day. And it was how many podcasts ago that we quoted Paul Tudor Jones just saying nothing good happens below a 200-day. And I know there's folks that will break out data, and really smart people that will break out data about forward returns when you're below a 200-day. They have some characteristics about being pretty good, and they could be again. But there's some really bad periods in market history where when you're below a 200-day moving average, it's a bad deal.
Yeah, and the trade-off is just, that's hard to be super aggressive long when you're below a falling 200-day.
Yeah, I mean, what we're saying is the past 200 days of information averaged is that sellers have control. It's the control line. I think John Roque uses that term. It's the control line. Who has control? Below a falling 200-day moving average, the sellers have control. I don't know what else to tell anybody. But all energy is not the same. So when I think of energy, I think of oil, gas, maybe natural gas. What other forms of energy are worth?
Coal.
Yeah, coal, right? That's been one of the better performing commodities for a while now.
Some of these lithium and uranium stocks try to perk up. Uranium's actually been on a pretty nice run the last week or so, getting hit a little bit here today or yesterday.
Solar. So there's your tech energy. So this goes back to, you can't just label everything tech and everything energy. There's certain things that are
That's true.
Energy tech, you've brought up that before. Or I think of like you just brought up coal. So if I told you that if you had held exclusively Indonesian stocks since the beginning of the year, that you would have 26% alpha versus the S&P, would you believe me?
I would, because I know the answer, but no. I mean,
right? Like how many people are sitting there going, yeah, Indonesian stocks,
Indonesia, man. I mean,
holding up pretty well. Again, I'm talking on a relative basis. On a absolute basis, they're positive for the year, but not necessarily.
I mean, it hasn't been a pretty ride.
Right. And the reason why I'm bringing up Indonesian stocks is a couple facets. So on one thesis, you would say, well, if Indonesian stocks are outperforming, how bad could the world be? Right? Because that's a pretty risk-on place.
Yes.
But then you look across the spectrum of other international areas, and it's not the same. So what's going on? Like, why is Indonesia showing such strength? And when you go and analyze it, well, Indonesia is heavily involved with coal.
Coal stocks have been strong.
And so that's really what we're really talking about if we do our homework, is the strength out of coal. And that's impacting the strength out of Indonesia. And so we don't get to lump and say, okay, because Indonesia is doing well, that just means this must be risk on because that's a, emerging market or a frontier market type scenario. We gotta think a little deeper about this. Seasonality.
We've entered the worst month.
Walk me through that. When you say that from a seasonal perspective.
September's the worst month of the year.
For since they've been tracking it. Is that what you mean? Okay.
Yeah. So we'll see. I mean, everyone, as much as we have talked about seasonality heading into this month beforehand, everyone else now seems vastly aware of what September is.
It does seem that there's a perk up. We've been talking seasonality
and then
probably since February.
So we've got here, everyone is very aware of it. Everyone and their mother has posted the seasonality charts. So it does make me wonder if it plays out the way everyone is expecting to.
Well,
going in, right? I mean, it hasn't been a good start. We're 2 days in, but last week of August and
would you say, Ian, the seasonality things that you've seen, whether in the financial media or on financial social media, would you say that it's using the overall seasonality? And what I mean by that is like taking every year into account.
Yeah, I would say majority of it has been just broad every September versus,
okay.
We usually break it down.
Right. So like, for example, this is a midterm election year. The map for the midterm election year of a first-term president is working out swimmingly. Again, it's not a predictive element. It's just paying attention to what it is, with the exception of April. And what I mean by that is in a midterm election year, April is positive.
Should be pretty strong.
Not this year. Pretty weak. That's one thing that pointed out, that showed itself as, this year could be weaker than normal because a normally strong seasonal period in that type of a midterm election year was weak. So September, first part of September tends to be strong if we consider all years. Also tends to be a little bit strong considering midterm years, but then falls off dramatically heading into late October.
Yes.
Again, not a prediction. It's just something we need to pay attention to. I'll always say, like, it means something when you go out to the tomato plant and there's no tomato. That's when you pay attention.
True. That's a great example.
So if the market doesn't fall off from mid-September into October, that there's a couple ways to view this. Because of April, we could see now through the end of October be increasingly worse from a bear market perspective. But if we're strong now through the end of October, November, December could just be rip roaring higher, like just incredible. So we'll see, but we don't know. We don't know until we get there. So that's our commentary on seasonality. Since it's at top of mind for a lot of people, we suggest looking at midterm seasonality because it's followed pretty closely this year, with the exception of April. So we talked stocks, sectors, seasonality, a little bit of rates. Should we talk anything like? There's plenty to cover here. We could talk metals, we could talk dollar, we could talk international stocks. We could talk about forgotten asset classes.
I mean, foreign still bumbling around like everything else. Weaker. Definitely continues to, I mean, they continue to be weaker. I mean, Europe's back at its July lows already.
Yeah. And it's, so think about this. It's at the October, November 2020 lows, basically, Europe. So we brought up Indonesia before. And should we be involved with Indonesia or Europe? I mean, the chart is the chart, man. I mean, that's why we use ratios. So while the industry says you should own a piece of international no matter what all the time, we can use the data to show us where, if we're even going to hold anything, where it should be. And sometimes we don't have to hold it at all. So your point is that international stocks continue to be weak, the majority of them. Is that fair?
I agree. Still what about the dollar?
And I think that's related, right?
Yeah, where's that play in all this?
We're at 20-year highs in the dollar. Now I'm using a trade-weighted dollar, and I know some people make a lot of arguments about that.
Weekly closing
highs. And the dollar versus the euro is much different than the dollar versus, the Brazilian real. If you look at currency pairs just on their own, what I mean is just 1-to-1. So if I just compare the Brazilian real to the dollar, that looks much different than if I just take the euro versus the dollar. I mean, Europe, I think I said this on one of our team calls. What's going on in Europe is a little bit surreal from many different aspects.
Yeah.
But, whether we're looking at European stocks, being at a price level, European financials, which, and I know that has to do with weighting, right? You've talked about that in the past, that the majority of European ETFs have a high quantity of European financials.
Very weak. I mean, you want to talk about an area that never really, it bounced, but from a technical perspective, European banks, you look at the big ones like Deutsche Bank, just lethargic. It was a 30% rally. Yeah, not going to deny that. But again, from a technical perspective, looking about what levels did it recover compared to what levels did other assets recover? Very weak.
Super weak.
I mean, we talk about this June consolidation in US stocks, right? That late May, early June breakdown, right? So we've talked about the S&P, that's 4180 on the S&P. S&P got back above that. I think all major indices got back above that. The closest that Deutsche Bank got was still 15% below. So when we talk about comparing different assets to how did it behave technically compared to other things, it had a 30% rally. Clearly, yes, it outperformed broad indices. But when looking at what did it recover, were we able to move past this big behavior level? Not even close.
Yeah. And that's a relative strength characteristic. Like it's worse.
Yeah.
Just worse. And dollar related, we can talk commodities.
Which had been, right? Commodities and dollar had been moving up together for a good chunk. Do we finally see commodities tap out and say, hey, this is too much of a headwind at this point. It's kind of starting to look at like that.
Well, yeah, I think you've harped on, I believe, oil at the 95 level. And we reclaimed it briefly one day and failed hard. And this is happening in the face of, you talked about dollar on a trade weighted basis using Dixie, trading at a new weekly high, 20-year high. Your point is made. Like, we're starting to see it have an impact on these strong commodity areas. So oil being one below 95, natural gas, right, looks to be, and that's the topic du jour. Like, how many people are talking about how much it's going to cost to heat a home in Europe this upcoming winter? I'm not saying that that's not going to be an issue. I'm just saying that that's a peak narrative when it looks like natural gas may have created some type of false breakout itself.
Mm-hmm.
Gold and silver are considered inflation protected havens. Mm-hmm. They haven't been. We've proven that. It's like a 50-50 proposition on whether that's true or not. But here we have gold at a massively important level.
Yeah. Would be a big breakdown.
This goes back to June 2020. If that breaks down, we're talking about gold reaching 20% lower from here, 18% lower, back to the breakout that we saw in June of 2019. That's pretty significant. And is that going back to the environment that we've talked about ad nauseum, the trade weighted dollar going to 120? It could.
I mean, the trends, until those trends end.
Yeah, I love
that's what you've got to kind of bank on happening.
Yeah, you're speaking my language. Until the trends end. And right now, new weekly closing high, 20-year high for the dollar on a trade weighted basis. You're seeing some of these really important metals like gold and silver break down. And then if we look at more economically sensitive metals.
Yeah, what about like the base? Like what is...
If we look at copper, that's not the greatest look in the world. I mean, you talked about weak bounces. I think you were talking about European financials and Deutsche Bank, and
steel stocks had held up strong too.
Yeah,
they were in this last rally. They were showing themselves as relative leaders, and they've all rolled over.
Yep. And so here you have a situation where, for example, copper versus gold breaking down again, base metals not looking great. International stocks continue to be weak. We have this interesting scenario with long-term yields, right, that haven't broken higher yet. They're still like at an important level. Is there an asset class that people have stopped talking about? We've covered a lot here, but
yeah, cryptos.
I don't even know what that is anymore.
No one talks about them. NFTs, all of it's just been gone. I mean, Bitcoin below 20,000. I mean, really, Bitcoin below 25,000, which is the VWAP off the lows, is rough. Now, Bitcoin, of course, zooming out, hasn't moved in 3 months.
I know what you're saying. You're saying it's the same price level it was in June.
It is.
However, it's below 30,000, which was a major breakdown level. And here we are at a major 20, and I'm using round numbers, but for whatever reason, they mean things to people. This 20,000 level, pretty big. And how forgotten will crypto be if we're down at 10,000 in something like Bitcoin? Or maybe,
a lot of tears.
Or maybe, yeah, just like you said, maybe it's weeping and gnashing of teeth, and it will be super noisy because of how bad crypto is. And there'll be magazine covers of that's probably where all the fraud's going to be exposed to. Like if we're seeing Bitcoin 10,000, 11,000.
The lawsuits are coming out.
Yeah, the lawsuits are coming out, right? Where the tide's gone out.
The blame game, yep.
That's
everyone's going to want theirs. Everyone's going to be told to say that they were duped.
Yep. Can I trade in my crypto? Can I get it back? Exchanges will continue to go down. You'll see funds blow up. You'll, like you said, lawsuits. You'll see just if Bitcoin's at 10,000, the amount of other crypto and tokens that will be much, much lower.
Worthless.
Yeah. And it will be pain. Now, again, this is not Ian and I saying this is what's going to happen. We're just saying we can see a narrative that would unfold if Bitcoin's at 10,000.
Yeah.
And
I mean, that would have been Bitcoin at 10,000. That's a couple of years of gain. I mean, you were back in the 10,000s. Would be a big behavioral level. We consolidated there for a long time.
Long time. So that doesn't mean we're not a believer in crypto. We just know that it seems to be a forgotten asset class at this point. Obviously, that's not 100% true because there's individuals out there that's all they're invested in. That's fine. That's their prerogative. That's not my recommendation, especially if we're looking at prices that could end up, because 10,000 is just the first level.
Yeah.
That doesn't mean it has to stop there. And really until we break these lows below 18.7, it's possible that maybe buyers show up here. It could happen. It could flip the other way, and people be like, remember when you were talking about weeping and gnashing of teeth? That didn't happen at all. Very possible. That's why we use price. All right, we have a 3-day weekend coming up. We've reached the end of our time for the podcast. Anything I missed or that we missed that you wanted to highlight, Ian, from the past week or from a big picture, even bigger picture perspective that's worth noting or that you wanted to touch base on?
I will say that this week, the behavior in particular that I found interesting was just this, the constant supply. Anytime indices tried to get going, they were immediately slapped down. Then you had the best attempt of the week came this morning. And we were up, 1.5% earlier on the S&P as we sit here. Then, a little less than a couple hours before the close, we're now down close to 1% for the day. So every single little, inkling of strength seems to have been just washed out. And I wonder, is this the end? Or is this just the beginning of the third leg where everything gets right? We talked about commodities rolling over. Like, are we entering the I just want to be in cash phase of the bear market?
Yeah, that's a great point, because we've talked about stages of markets before, right? And we were in a stage prior to this that was stocks down, bonds down, commodities up. You're saying, are we entering the stage where it's everything down, everything correlation for everything goes to one, just be in cash, and there's all sorts of behavioral things happening behind the scenes, such as like, let's go ahead and harvest these tax losses. And that because it's September, baby. Like, this is when people return from their vacations. The guys and gals return to their trade desks.
Well, and I wonder if this last rally with the breadth thrust we had and we talked about this last week on the podcast 2 weeks ago, that there's great individual setups out there. And a lot of them have been wiped out. Those leaders, your Celsiuses, your Enphase. We can go through a lot of them, all rolling over and breaking down.
No, that's a great point. You're saying something like CELH had a breakout, a really nice breakout. August 23rd failed. That's what you're talking about.
Yeah, you still saw a lot of that action where, as if you're an individual trader, you've probably a lot of these people that have gotten involved in the market in the last couple of years. And it's just like, I wonder, I think there was I think at the beginning of the rally back in June and July, there was the sense of, okay, we're at the light at the end of the tunnel. We're getting the breath. these individual growth names that we love, they're starting to form bases and turn around. You know, I'm going to make it through this. And then there was this, it all got wiped out over the last 2 weeks. And will that be kind of this final, I don't care, I just want out type of attitude that overtakes market participants?
Yeah. I mean,
if you're right, if you're in these growths, I mean, and they're still down 50, 60, 70%. And then they're only down 60. And you get a little excited, right? And now they're back down 75, 80. And
oh, that's so funny. I don't mean to laugh at anybody's pain. I'm just, your point is made.
It's human. It's human. Like if you're not watching a chart and you're just going on, oh, this is down X. Oh, now it's not down as much as it was. It's not, maybe this is it.
Yeah.
I could see a lot of people just emotionally pulling the plug. Like if you got involved in 2020 and everything was great, and then 2021 and 2022 have just been an emotional nightmare.
Your point is made. There's lots of things that since February of 21 are down. You know, their initial lows were about 75%. They rebound and it feels like minus 65%, but yet here we go and sell off again. I mean, how much does supply have control if that's happening?
Yeah. And I feel like supply has kicked up the last 2 weeks.
Yes.
Like after the rejection off the 200-day, after 26th. All these, after we broke 41.80, after all the indices, it was kind of this, like, all right, we're not, like, market participants kind of collectively saying, I don't think we're going higher. I'm going to use this as a chance to sell out of what I should have sold out of earlier in the year.
No, 100% true. Minimal bounces out of the things that have been sold the hardest. To your point, like this morning was the first attempt for buyers to take control on a near-term basis, near-term being like, an hour to a few days, and that failed. And this breath thrashing that we've seen between August 26th being the most recent example, basically in my impression, wiping out July 19th. July 19th being this breath thrust to the upside, break higher.
It's not healthy. This is not what you would see in a bull market.
Correct. Well, and this goes back to, right, the best days happen in the worst markets. We see violent rallies in bear markets, right? The small caps ripped almost 23% off the lows in June. And you hear that number, right? Investors hear the number 23%, and they're like, that's amazing. Like 23%.
That's a whole year's worth of gains.
That's amazing. Like that might be 3 years worth of gains. Like, are you kidding?
The market must be really moving.
Yeah. But even that rally, you were still at minus 17 since the highs. And now we're sitting at minus 25. And it's just these rallies that happen in bear markets. They just rip. Yeah. They're okay. I'm going to leave it there. That's great. Bear market rallies are bear. I like that. We're going to leave it there. We know our listeners are hard workers. I know the adaptive team is hard workers. That's why Labor Day is amazing. You guys can rest from your labors. Rest is hugely important. You could even argue scriptural. And so I want to wish the adaptive team a great 3-day rest from these bear market bears, and all our listeners the same thing. Rest.
Yeah. Appreciate that, Dave.
Hey man, I know how hard you work. So you enjoy your 3-day with your family.
You do the same. I think we all will. I think we're all going to have some great family time this weekend.
Yeah. You go to Portland, visit Clyde the Glide, come back rested. Sound good?
Sounds great. And everyone else, you have a great weekend as well.